Moments ago, we got some breaking news that will be of interest to you if you hold XRP. I want to discuss what just came out of the White House, some XRP numbers, and a 500x for XRP that's being put out there. And I want to discuss in this video what would actually need to happen this year to make that a reality. Let's get into it. There is a lot of noise in the market right now, but today we actually got something concrete that deserves your attention. This morning, CME Group put out a statement that most people are completely glossing over, and that's a mistake. CME Group is not just another exchange. This is the largest derivatives exchange in the world. Institutions live here. Banks live here. Sovereign funds live here. And when CME talks, it's not hype. It's data. Their exact words were this: since launching in May, we've seen incredible demand for this regulated product. Ready for more? 567,000 plus contracts, nearly 27 billion in volume, equivalent to 9 billion XRP. Now, I want to be very clear about something because this is where people get confused. Futures do not directly push XRP's price higher. They don't. Anyone telling you that futures alone are the reason price explodes does not understand market structure. Futures are a signal. They are a message. They tell you that institutions are preparing, positioning, and getting comfortable with XRP as a financial instrument. Futures build plumbing. They don't turn on the water. Spot ETFs are what turn on the water, because spot ETFs require actual XRP to be held. That is direct demand on a fixed supply. And that is exactly why what CME just said is so important. They are essentially telling the market this product worked. The demand is here. Be ready for what comes next. That brings us to something I personally think is critical for anyone following this space to understand, because if you want to know how to position yourself before this shift goes public, you need to be inside XRP Insider Elite. This isn't just a membership. It's a full institutional level breakdown of what's happening behind the scenes with clear visuals, premium research documents, and in-depth video walkthroughs that explain how the private to public transition actually unfolds. Inside, you'll see the key triggers to watch for, how early is positioning, and what matters most as XRP enters its institutional phase. You'll find it in the pinned comment below this video. All right, let's go deeper. Now, when zoom out and look at what's lined up, it becomes very clear why so many institutions are circling XRP right now. You have spot XRP ETF filings from Bitwise, CoinShares, WisdomTree, Canary Capital, and others already in motion. History tells us how this goes. First comes futures to test demand, then comes spot ETFs to capture it. We saw this exact playbook with Bitcoin. XRP is simply later to the party because of regulatory warfare, not because of lack of interest. And now that those barriers are coming down, the infrastructure is being laid very deliberately. At the same time, you have mass media and even crypto media completely misrepresent what's actually happening. Today, headlines start circulating saying things like, Ripple co-founder cashes out again, or Chris Elson dumps millions in XRP. This is how narratives are manufactured. What those headlines conveniently leave out is that Chris Elson, along with other major players, has been involved in funding and backing what is now becoming the largest XRP treasury structure in the world. We're talking about tens of millions of XRP committed long-term. That's not a lack of confidence, that is conviction. This is why it's so important to separate signal from noise. The real signal is coming from institutional behavior. CME volume is a signal, ETF filings are a signal, custody infrastructure expanding is a signal. None of that happens if XRP is dead or irrelevant, no matter how many times you hear that repeated on social media. Markets don't lie, but narratives do. Now let's talk about what just came out of the White House and why the broader market is still feeling heavy. We are dealing with a government shutdown situation that has effectively put a wet blanket over risk assets. Add in tariff talk, trade war rhetoric, and uncertainty around global negotiations, and you get suppressed liquidity. This is not unique to XRP. You're seeing it across equities, crypto, and commodities. Liquidity providers pull back, algorithms reduce exposure, volatility compresses, price action goes sideways or bleeds. That's the environment we're in right now. However, today we learned that President Trump is scheduled to meet with Chinese President Xi Jinping next Thursday. We also learned that Treasury Secretary Scott Bessent will be meeting with China's vice leadership as well. These meetings matter because markets are forward-looking. They don't wait for outcomes. They reposition ahead of potential shifts. The end of a government shutdown, clarity on trade, and easing geopolitical tension are all catalysts that unlock liquidity. And when liquidity comes back, it doesn't trickle in evenly. It rushes into assets that are already structurally prepared. XRP is one of those assets. This is where the conversation about a 500x starts entering the discussion. And I want to handle this carefully because it's easy to get reckless with numbers. A 500x move is not something that happens because of one ETF or one announcement. It requires a chain reaction. People like Jake Claver, who has been in this space longer than most and understands the plumbing of global finance, are not making these statements lightly. When he talks about extreme upside scenarios, he's talking about systemic shifts, not just bullish cycles. Now, for a 500x move to happen within a year, you're talking about extreme macro events. You're talking about serious stress in the bond market. You're talking about breakdowns in traditional liquidity channels. You are talking about carry trades unwinding, leverage snapping, and capital fleeing into alternative settlement assets. You are talking about scenarios where the existing financial system shows visible cracks and capital looks for rails that are faster, cheaper, and already integrated. XRP fits that narrative, but only under those conditions. That's why it's important to separate probability from possibility. Is it possible that XRP sees triple-digit prices over time? Yes. Is it possible that ETFs alone drive XRP well beyond where most people expect? Yes. But four-digit XRP in a single year would require a convergence of events that go far beyond crypto adoption headlines. It would mean something is breaking elsewhere. And while some believe that's inevitable in the long run, timing it to a specific year is extremely difficult. What is far more grounded and frankly more important is what we can already see forming beneath the surface. XRP is being positioned as a liquidity asset, not a speculative toy. Futures volume confirms institutional interest. ETF filings confirm long-term demand intent. Regulatory clarity is improving. Global payment corridors continue to expand. All of this is happening quietly, while price action remains relatively muted. That disconnect is exactly where long-term opportunities are born. And as we move through this environment of uncertainty, suppressed liquidity, and headline-driven fear, the structure keeps improving. The pipes are being laid, the rails are being tested, the players that matter are getting comfortable. And while the market waits on macro clarity, XRP continues to embed itself deeper into the financial system, step by step, contract by contract, filing by filing, without fanfare, without hype, and without asking for permission. And this is where the conversation naturally has to shift from what people think moves markets to what actually moves markets, because the next layer of news coming out right now is far more important than short-term candles. While everyone is staring at 5-minute charts, institutions are watching policy, liquidity flows, and regulatory posture. That's where the real story continues to develop. Over the last several days, we've seen a subtle but meaningful change in tone coming from Washington, and it's not being discussed nearly enough in the crypto space. Behind the scenes, the White House has been signaling a renewed focus on financial stability and cross-border coordination. When you hear about meetings with China, Treasury officials, and trade representatives, this isn't just about tariffs. This is about capital flow, settlement risk, and dollar liquidity. The global financial system is under stress, not collapsing, but strained. Sovereign debt levels are high, yields remain volatile, and confidence in traditional settlement systems is being tested. In that environment, assets that can move value quickly and efficiently become strategically important, not just speculative opportunities. That's why XRP keeps showing up in places where most retail investors aren't looking. Payment corridors continue to expand quietly. Central banks continue to test tokenized settlement frameworks. Financial institutions continue to experiment with on-demand liquidity models. None of this creates instant price explosions, but it creates necessity. And necessity is what drives long-term demand, not hype cycles. At the same time, the regulatory backdrop is shifting in ways that directly benefit XRP. The aggressive enforcement-first approach that dominated the last few years is fading. We're seeing more dialogue, more rule-making discussion, and more acknowledgement that crypto assets are not a monolith. XRP, in particular, sits in a category that regulators increasingly understand: utility-based digital assets designed for payments and settlement. That distinction matters, especially as spot ETF conversations continue behind closed doors. Speaking of ETFs, it's important to understand how these processes actually unfold. Approval doesn't happen in a vacuum. Regulators look at market maturity, liquidity, depth, custody solutions, surveillance, sharing agreements, and derivatives markets. This brings us right back to CME. That futures volume isn't just impressive for headlines, it checks boxes, it demonstrates market participation, it demonstrates price discovery, it demonstrates institutional grade engagement. Each one of those data points strengthens the case for spot products. And when spot ETFs arrive, they don't just attract retail money. They attract pensions, endowments, and funds that cannot touch self-custody crypto or offshore exchanges. Even small allocations from those entities represent massive amounts of capital relative to current XRP liquidity. This is why supply dynamics matter so much. XRP is not infinitely liquid at scale. When demand ramps, price adjusts quickly. That's not speculation. That's market mechanics. Now, layer this on top of the macro situation. Liquidity providers are still cautious. The government shutdown has created uncertainty. Trade negotiations introduce risk, but markets don't stay compressed forever. When pressure builds, it releases. And when it releases, capital moves fast. We've seen this repeatedly across market history. The assets that benefit most are the ones that are already positioned, already compliant, and already integrated. XRP checks those boxes in a way very few digital assets do. Assets. This is also why dismissing XRP based on outdated narratives is increasingly dangerous. The idea that XRP is centralized, irrelevant, or doomed by regulation is a relic of the past. That battle has largely been fought. What remains now is execution. Can XRP scale? Can it handle volume? Can it integrate with legacy systems? Those questions are being answered in real time through pilots, corridors, and production use cases, not marketing campaigns. And this brings us back to the extreme upside conversations. When analysts talk about massive moves, they're not talking about retail FOMO. They're talking about repricing. Repricing happens when an asset transitions from speculative to systemically useful. Gold has gone through this, bonds have gone through this, even Bitcoin went through this phase. XRP is still early in that transition, which is why volatility remains high and sentiment remains divided. If something in the broader financial system breaks, even temporarily, the repricing can be violent. Capital doesn't ask for permission. It seeks safety, efficiency, and certainty. XRP's role as a bridge asset becomes incredibly relevant in that scenario. That doesn't mean it replaces everything overnight. It means it absorbs flows that were previously unthinkable. That's how exponential moves happen. Not through hype, but through necessity meeting infrastructure. What we're seeing right now is a market caught between fear and preparation. Fear dominates the headlines. Preparation dominates the behavior of serious players. This disconnect is uncomfortable, but it's also where opportunity lives. The people waiting for perfect clarity usually arrive late. The people paying attention to structural changes arrive early. And structurally, XRP continues to strengthen. More regulated exposure, more institutional participation, more geopolitical relevance, more integration into discussions about the future of payments. None of this guarantees a specific price by a specific date, but it dramatically increases the range of outcomes compared to where XRP was just a few years ago. As the market moves forward, the next catalysts won't come with sirens. They'll come as filings, meetings, pilot programs, and liquidity shifts. Price will react after the fact, not before. That's how it always works. And as we move through this period of suppression and uncertainty, the groundwork continues to be laid for what comes next, with XRP sitting squarely in the middle of those developments, quietly absorbing significance, while the rest of the market argues about narratives. This is not financial advice. Globally, debt levels are becoming harder to ignore. Governments are rolling over obligations at higher rates. Balance sheets are stretched. And confidence in long-term fiscal discipline is thin. When you hear central banks and treasury officials talking more frequently about coordination, stability, and contingency planning, it's not accidental, it's preparation. And in periods of preparation, assets that solve real problems tend to be pulled closer to the core of the system rather than pushed to the edges. This is where XRP's positioning becomes critical. XRP is not trying to replace currencies, it's not trying to overthrow central banks. It's designed to move value efficiently between systems that already exist. That makes it politically palatable and financially useful. In an environment where cross-border payments, remittances, and settlement efficiency are under scrutiny, that utility becomes more relevant by the day. The news coming out of policy circles increasingly reflects this shift in mindset. At the same time, institutional risk tolerance is changing. Funds are no longer asking whether digital assets will exist in the future. They're asking which ones will survive regulation, scale under pressure, and integrate with legacy infrastructure. XRP continues to show up in those conversations because it's already been stress tested both technically and legally. That matters far more than social media sentiment. Another key development that deserves attention is how liquidity is being managed behind the scenes. Large players do not chase green candles. They build positions during periods of uncertainty when volume is thin and narratives are negative. The CME data, ETF filings, and expanding custody solutions all point to accumulation behavior, not distribution. This doesn't mean price immediately reflects that behavior. It means supply is quietly being absorbed while the broader market remains distracted. When the conversation turns back to extreme upside scenarios, it's important to understand the difference between disbelief and unpreparedness. Most people dismiss large numbers because they anchor to current prices, but markets don't move linearly. They move in regimes. A regime shift occurs when the underlying assumptions about an asset change. For XRP, a regime shift would mean being widely recognized as critical financial infrastructure rather than a speculative token. That shift doesn't require universal agreement. It requires adoption by the right players. If macro conditions deteriorate even modestly, the demand for efficient settlement could rise dramatically. Stress in the bond market, volatility in currency pairs, or disruptions in correspondent banking all create pressure points. XRP is designed to relieve those pressure points. And when systems are under stress, solutions that work are adopted faster than anyone expects. This is why dates matter less than readiness. You don't need everything to break for XRP to move. You just need enough friction in the old system and enough confidence in the new rails. We are much closer to that threshold than most people realize. The infrastructure is there, the regulatory clarity is improving, the institutional access is expanding. Those are not theoretical developments, they are happening now. What we're watching unfold is a slow handoff from skepticism to pragmatism. Early critics argued XRP had no use case. That argument has largely disappeared. Then they argued regulation would kill it. That argument is fading. Now the remaining resistance is psychological. People struggle to accept how quickly relevance can turn into repricing. But history shows that once that line is crossed, markets move violently and without warning. The most telling sign is not price, it's behavior. When serious financial entities stop debating whether an asset belongs in the system and start figuring out how to use it, the outcome is no longer a question of if, but when. XRP is firmly in that phase. Every quarter that passes brings deeper integration and broader acknowledgement, regardless of what short-term charts show. As we look ahead with clarity on trade negotiations and renewed liquidity could act as accelerants, not because they directly pump price, but because they remove constraints. Once constraints are removed, capital flows to where it sees durability and efficiency. XRP offers both. And in markets, durability plus efficiency is a powerful combination, the kind of shift that doesn't just change a price tag, but redefines how every major financial institution operates. When the liquidity from private systems merges with the public ledger and permission domains go live, the stage will finally be set for XRP to operate as it was designed to, as the backbone of global value exchange. And that's when we'll see the difference between those who are watching and those who are positioned. Because history doesn't reward the observers. It rewards the participants who understood the structure before the rest of the world caught on. And if you understand that, then you already know exactly what kind of moment we're in right now. If you want to see how to position yourself ahead of that shift, how to understand the architecture, the timing, and the strategy behind what's unfolding, you need to check out the XRP Insider Elite. It breaks down the system in full detail with visuals, documents, and a step-by-step breakdown of how this transformation is being built and where it's heading next. You'll find the XRP Insider Elite linked in the pinned comment below,